Good morning. I'm here this morning bearing good news. Next to what interest rates are going to do, the most common question I am asked is, when is financing going to get back to normal? Well, it has, and it is. As it relates to multifamily, stabilized properties, with few exceptions, we're back doing business the way we did prior to the overheated years. I'm going to say started about 2005. You'll hear those called the frothy years. I always thought that was a cappuccino, but in the business now, they're calling it, the capital markets are calling those the frothy years. When it comes to the fundamentals of multifamily real estate and multifamily term lending, most of the data points that we follow indicate that things are improving. No longer are Freddie Mac, Fannie Mae, and HUD the only lenders financing multifamily. All of the insurance companies are back, as are many of the banks and conduits. Lenders are competing to finance stabilized multifamily properties, and it's been quite a while since we've been able to say that. What has caused the change? Big reason is that multifamily debt capital is perceived as having one of, if not the best, risk-adjusted returns available today. Put in other words, if you are a bank, an insurance company, or an investor in bonds, you want to own multifamily debt. That begs the question, why is multifamily debt capital considered to have a better risk-adjusted return than the alternatives? There are a number of reasons. You're going to hear a lot of them today. First, multifamily as an asset class has been repriced. There's very little concern in the capital markets that values will decrease any further. Secondly, and it was been talked about a little bit this morning, the fundamentals of multifamily properties throughout the country are strong. Vacancy rates are down, effective rents after vacancy and concessions are up. And third, as good as the fundamentals are, it's felt that they're going to get better. Those of you who were here a year ago may recall Dwight Untie's presentation. Dwight did a great job. One of the things he mentioned is a disconnect between rents and costs, and saying that you're not going to see a bunch of new construction until rents rise. That was true then, that's true today. Another important point that Dwight made was that demographics favor apartments. Huge issue. Huge issue. What are some of the new trends that we're seeing? Insurance companies are back in the lending business. They're back in a big way. They'll now compete with Fannie, Freddie, and HUD when it comes to, well, at least Fannie and Freddie when it comes to interest rate. They're not competing when it comes to leverage, however. Insurance companies are not requiring funded replacement reserves, and they're oftentimes locking the interest rate up front. Insurance companies were a leading source of lending capital in 2010. Origination volumes were up 155% from 2009. Excuse me a second here. CMBS, also known as Conduits, are back. They did approximately $10 billion last year, which, considering they didn't do anything in 2009, that was pretty good. They're expected to do 40 to 50 billion this year. You'll hear the second coming of CMBS referred to as CMBS 2.0. Currently, CMBS is struggling financing multifamily. Don't worry, they'll find a way. They always have, and I think they will again. As an industry, banks struggled last year. Their volume was down from 2009. Well, there are still quite a few banks dealing with capital inadequacy issues and or portfolio issues. There are a number of banks that are healthy and looking to do business. They, like others, are seeing good value in financing stabilized multifamily properties. Banks will increase their volume and market share this year. Only 3 banks failed in March, making it the slowest month in bank failures since December of 2008. Now, I was hoping I could leave it on that note. However, last Friday, 6 banks failed, making it one of the busiest Fridays for the FDIC. Historically, banks have been the primary source of construction loans. The good news is that they're starting to see some banks coming back and encouraging construction loan business. However, we're still not seeing that many construction loans being made. There's a lot of reasons for this, not the least of which is the disconnect we talked about with rents and costs. You've got to give Fannie, Freddie, and HUD credit. They funded loans the last few years when no one else would. Fannie and Freddie's loan volume was down in 09, and down last year compared to 09. HUD's volume, on their hand, was up. Even so, Fannie and Freddie are still the gold standard everybody compares themselves to. Going forward, they're still going to have the dominant market share, although this year they're going to lose market share to both of the banks and insurance companies. We're seeing a great deal of interest from a few opportunistic lenders wanting to make bridge loans to reposition properties. These lenders are seeing that the markets will accept moving a property, say, from a C to a B. This wouldn't have been even thought of a few months ago. The reasonable interpretation is that lenders now are much more accepting of taking some risks. Earlier I said that we're back to normal. An exception is the loan process. The process of getting a new loan today is much more challenging, especially when dealing with lenders that have been struggling with problem loans. We'd probably all agree there was a time when lenders didn't ask enough questions. Today, the opposite's probably true. We call it death by 1,000 questions, or the never-ending ladder of questions. It's obvious that many cases lenders today are afraid of making a mistake or being criticized by an examiner. Multifamily sales transactions in 2010 were more than double what they were in 09. It's especially interesting to note that they were up each quarter. Multifamily loan volume in 2010 was up 22% from 09. And what is more telling than that is that the fourth quarter 2010 was up 81% from fourth quarter 09. For the first time in a long time, total multifamily mortgage debt outstanding increased. There were more loans made on multifamily loan properties last year than were paid off or paid down. Overall, multifamily debt outstanding ended the year up by $7 billion, bringing an end to deleveraging. You go ahead and check the box there, Steve. I mentioned earlier that most data points that we follow indicate that things are improving. An exception is mortgage delinquencies. Mortgage delinquencies ended the year up for all but insurance companies. Insurance companies started the year with a delinquency rate of 0.19%. That's also how they ended the year. Fannie Mae started the year at 0.63%, ended at 0.71. Freddie Mac, 0.2 is the way they started the year, ended at 0.31%. Again, we're talking about less than 1% obviously here, so those are pretty good numbers. Banks started the year at 3.92%, ended at 4.09. CMBS, they won. They started at 5.7. They ended at 8.95%. Short term, we're trying to stay away from predicting interest rates. Long term, we don't see how they can't do anything other than increase. The vast majority of the reports that we get from economists make it a point that we're starting to see some, not a lot, but some inflationary pressure. And later this year, they believe the Fed's going to have no choice but to start pushing up interest rates. In summary, multifamily debt is perceived as having one of, if not the best risk-adjusted returns available. No longer are Freddie Mac, Fannie Mae, and HUD the only lending source. There's now competition from insurance companies and banks. There's still not many construction loans being made. Volume of sales and loans have been increasing. We've seen the end of deleveraging. That's number 2. With the exception of the insurance companies, delinquency rates have increased for all lenders. Interest rates will likely increase by the end of the year. Thank you, and welcome to the new normal.